Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Robert Greifeld. Bob is a former CEO and chairman of Nasdaq, Inc. He's currently chairman of Virtu Financial, a leading financial technology and trading firm, managing partner and co-founder at Cornerstone Investment Capital, a financial technology investment firm, and a board member at Capital Rock and Financeware. Bob is chairman and founder of USATF Foundation, an organization dedicated to supporting both athletes from disadvantaged backgrounds and our next generation of Olympians. Bob also serves on the NYU Stern Board of Overseers. Today we're going to be discussing his book, Market Mover, Lessons from a Decade of Change at Nasdaq. Let's ask Bob 5 good questions. But first, I'm happy to announce my literary debut, The Rebel Allocator, is now available on Amazon in both print and digital formats. You could say it's about time. I've been pouring my heart into this book for more than 3 years. A well-known SoCal billionaire received an early copy of the book and actually called me to say he enjoyed the story and was adamant that I get it made into a movie. Talk about a surreal experience getting 20 minutes on the phone with one of my heroes. My friend Tobias Carlyle had this to say: Jacob Taylor has written a modern-day investment classic. The Rebel Allocator is reminiscences of a stock operator for value investors. It's a fictionalized retelling of the lessons in The Intelligent Investor in an accessible page-turner. If you want to learn how to invest like Warren Buffett by sitting at his knee, this is the book for you. Wow, how flattering is that? I was blown away when he sent me that. I've created dozens of ad-free author interviews over the last 5 years and never asked for anything in return. If you've gotten any value out of these efforts, please do me a personal favor and pick up a copy of The Rebel Allocator. I promise you won't regret it. And now, on with the show. All right, welcome back to the program, everybody. My guest today is Robert Greifeld, and he's the author of Market Mover. And Bob, thanks for chatting with us today.
It's my great pleasure. And call me Bob, please. You call me Bob.
Yes, sir.
Yes. Okay,
so one thing that I found really fascinating, just to start off about your book and your time at Nasdaq, was that, I guess I should have realized this in hindsight, but the Nasdaq sits at a really interesting kind of confluence in the business world of, you're interacting with business leaders, VCs, public equities, the SEC, Washington, D.C., all of these different constituents. Basically, everybody kind of has to come through you at some point. Like, isn't that, were you surprised by that when you first took that job, or was that something you realized straight away?
No, I was surprised because I came from a, technology entrepreneurial background, and I was micro-focused on correcting our position in the trading of our listed stocks. And that was my myopic view. When I got to Nasdaq, I realized I was not prepared, one, for the publicity associated with the position, the Washington outreach associated with the position, and the amount of time the listing business would take. That is, dealing with the CEO of our listed companies. So as I say that, you might say I was unqualified. I don't know. But I was very qualified in one or two areas, but unqualified in others.
Yeah, that's amazing. So question number one, and this is a little bit kind of topical for this time period, but what do you think about the online brokerages all moving towards zero equity and other option trading fees?
Well, I was certainly surprised that it happened that quickly, but I always say you have to look at the whole business model. And clearly when somebody goes to zero in one part of the business model, they're making money on other parts. So when you look at the brokerage business, it always has been a business where they make more money on the provision of margin in the marketplace, and also they make money on basically the money they'll pay on the balances in the account. So whether you're borrowing money or depositing money, they'll make money there. So if I had to guess at it, I would have thought they went to zero commission when kind of the margin rates were higher. So I was maybe not surprised that it happened, but surprised when it did happen.
Yeah, and what do you think about, it seemed like, I think Schwab went first, and then after that it was like, was everybody ready for that, or were these sort of knee-jerk, like, oh God, we got to keep up with everyone else?
Well, I think the storm clouds were out there because you had one, Robinhood as a startup going to zero, making money in other ways. You had IBKR, getting ready to go that. So people knew it was surfacing, but nobody, I think, expected to happen with the rapidity. But once the first two went, Schwab went, then the others really were not left with much of a choice. And I think Schwab's calculus is probably quite strong because on a relative basis, they do better. because I think their franchise with respect to collecting money on latent deposits and also providing margins are probably better than the other folks.
So you kind of torpedo one part of your business to hurt your competitors more.
I think that's certainly an element of it, and that was reflected in the stock prices, right? Schwab went down 3, 4, 5%, others went down 8, 9, 10, 12%. So you definitely saw that.
Yeah. So question number 2, what do you think about the shift between active and passive? And, as someone who was in charge of an exchange, are we losing some of the wisdom of the crowds when we have a lot more passive investors, and maybe one of the requirements of the wisdom of the crowds is a heterogeneous population, and if we don't have that as much, is there cause for concern that maybe price discovery is not as strong as it used to be?
Well, I think you raise a very interesting point, and I would say there's multiple dimensions to the point you raised, but clearly if I am the only active manager left and everybody else is passive, and by passive meaning they have to follow rules with respect to the portfolio construction, right? I think I do very well as the only active guy. So at a point, and when everybody has dumb rules they have to follow or uninformed rules, and I can then maneuver around them, I think the active guys will tend to do better. So I think you'll get to a natural balancing act. But with respect to the fact we have passive in the market, I think it's a good thing in general, because I think most investors should not be in the business of trying to pick winners, right? When they think about their life plan and the lifetime financial planning to buy into this market or that market, I think is a good thing.
Do you think, is there a percentage in your mind that is kind of a tipping point there, where now we're too passive, or too many free riders, or do we even know that? Can we know what that number is?
Yeah, I don't think we can really know it, but we can still talk about it, right?
Yeah.
We can't know for sure, but I think to the extent you see the preponderance of passive, compromising the price discovery function, would be a time to say it's too much, or more importantly, it's time to say it's time to be more active. Right, so I'd rather see the natural market forces balance themselves out over time. As passive gets to be too large and has certain distortions in the market, if you're active, you can take advantage of those distortions, and then that will then self-correct it the other way.
Yeah. So question number 3, you successfully executed dozens of acquisitions when you were the CEO of Nasdaq. What are some of your keys to good M&A, and also what are some of the risks to watch out for?
Yeah, again, that's a very strong question. So I have very strong thoughts on it. So one, I subscribe to the theory that if you're doing a small tuck-in acquisition that is in the line of business space you're in today and is in your geography, right, then that's pretty straightforward and pretty easy. Small acquisition, there's no discussion of culture. You're now part of the bigger company. Your culture subsumed in, and then because you're geographically close, you've got the personal interplay. On the other side, if you do a acquisition as large as you are in a line of business that is somewhat remote from where you are, and they are physically remote, red flags have to go off. A lot of times those acquisitions do not go well. So you get those basic factors. So we redlined it one time, in my mind, with respect to acquisitions when we acquired OMX, which was the Nordic exchanges. Clearly, they come from a different societal culture than we did. Plus, they had an equity franchise like we did, which was common, but they also had a derivatives franchise and a clearinghouse, which we didn't own at that point in time. So we had lines of business we were not masters of. They were physically separate, and they actually had more employees than we did. Not more revenue or profit, but more employees than we did at a time. So that one I was on guard that, okay, these are the kind of acquisitions that can easily fail.
That one might lead to some indigestion, potentially.
Yes.
So I really found that interesting, the geography component. And I don't know if people think about that as much today with, you think the world is so small, you can hop on a plane and be anywhere within, 12 hours.
Yeah.
But, I think geography still does matter. Like, do you agree with that?
Oh, completely. We put in high-end video conferencing so we could see each other and talk. So I would rate, a telephone call on a scale of 1 to 10 is a 1. A video call is like a 5, but a face-to-face is still a 10, right? So if you're lacking a lot of that face-to-face contact, that has a pernicious impact on how the integration will go. So I thank God for the video, because 5 or 6 is certainly better than just doing telephonic calls, but you still cannot replace people being in the same physical proximity to other people and dealing with them in that context.
Do you think that applies both from like the leadership kind of downward in the hierarchy as well as like cross the organization?
Oh, definitely. I was a software entrepreneur, and when we started the company, we had everybody in one physical room. The amount of communication required, bureaucracy, is just remarkably different than a larger company. So I always use that as my North Star. I said, okay, we're Nasdaq level efficient, but we're not entrepreneurial efficient, right? We don't have everybody in a single room. So anytime you get larger and move geography, move lines of business, then you have to build infrastructure to manage it, right? Where it brings a certain level of not just inefficiency, but risk that you don't execute as well. You're all in a single room. Any person who's not contributing is recognized by the entire team instantaneously, and then you have such nonverbal communication that happens all the time. You can really operate at the speed of thought, right? So that is the North Star. That's what we aim for. So always trying to build the bigger organizations with that as the reference point.
What was more fun, being in like the pit with everybody in the entrepreneurial space, or kind of more in the C-suite,
I would say there is nothing more fun than being in a startup company that's working there. So that's clearly the greatest amount of fun. But I'd have to say building a global company is a unique and different satisfaction, which I enjoyed basically every minute.
Question number 4. Amazon went public at $440 million valuation. Google was 23-ish billion. Facebook's 100-something billion. Each IPO seems to be maybe coming a little bit later in the potential life cycle of the business. Is there any concern for us public equity investors that maybe a lot of the growth has already happened before we get a chance to be the owners?
Yeah, I think there's no concern whatsoever. So I hear this talked about a lot, and I'll take it from two sides. So the one side is, if you're running the company, right, your job is to build an institution over time. When you go public is a detail within that construct, right? When it makes the most sense for you. I get annoyed when I hear people thinking the company mistimes the IPO, as if they're trying to rip off investors by trying to foist it upon them just before their growth goes flat or negative. That's not what you're there to do. You're there to raise capital. We need capital to grow. Now, on the other side, investors, right, we have public markets to determine what kind of price you have to pay for a company growing 50%, 30%, 20%, no growth, no growth with dividends, that kind of thing. So when you look at companies when they come to market, you look at that situation. All right, they grew 50% in the past. Now they're growing 20%. I'm going to pay a lower multiple for that, right? That should be reflected in the stock price, right? So you just have to be wise about how you approach this thing. Just because it grew 50%, it's not going to do that forever, right? Trees don't grow to the sky, and then you have to pay what is a fair price for where the company is at that particular point in time.
What do you think about this recent? I don't know. There's been a lot of talk lately about direct listings.
Right.
What do you think about those now versus the IPO?
Well, I like direct listings. I think it will have a particular niche in the marketplace, and it should have a niche in the marketplace. So it separates out the fundraising, right? So most companies who come public need fundraising. So the direct listing doesn't address that major part of the market at all. But those who don't need fundraising at that point in time, the advantage I see is you can come public, you can have a price established in the marketplace by public investors, and then a year from now, 2 years, 3 years, when you want to raise capital, then you have a known price. If I'm a company, I come public, and I have my stock go up 30% or down 30%, that's not a good outcome, right? I'm not in the game of trying to game, what that price should be. I'd rather take that decision away from myself, let the market decide. And then when I know I raise capital, I didn't get ripped off, but nor did I get a great deal. And that's fine, right? I'm here to raise capital at a fair price. I don't want to feel stupid for having the stock go up 50%, nor do I want to feel stupid by having it go down 50%, that kind of thing. So I think, niche market, most people will have to raise capital, but for the market, for those companies that don't need capital, I think it's a great outcome.
Do you think that a lot of that direct listing comes from the trying to give their employees some liquidity at that point?
Yeah, there's that's certainly a part of it. Yeah. I think when you look at the long-held private companies, that's one of the big issues. So when I was at Nasdaq, we started Nasdaq Private Market, and we acquired shares post and second market. And one of the key things was driving force behind that is you have employees who want to buy a house, who want to provide for kids' education. They should have a way to do that, and we did that sponsored through the company. And then as the market evolves, it will allow early stage investors also to get some liquidity independent of having to go public to do that, right? Because you certainly, if you want to stay private for a long period of time, that's your right. But you do have employees who need to get on with their lives.
Right. So question number 5. We're looking for a story here. You got to interact with a lot of CEOs, really high-profile CEOs, as they listed, or just in your business dealings. What's a memorable moment from your career in that time period?
Sure. I'll give you 2 stories that are in the book, or summaries of the story. So one, this fellow was not memorable at the time, was relatively unknown. So before I was at Nasdaq, I was a software entrepreneur. And I used to lug around the Spark 20-inch monitor and give the demonstration of my trading system for Nasdaq market makers. And the software is primarily mouse and keyboard based. It wasn't a piece of middleware. So I go into this office this one day, and the office is maybe 9 by 12. It's a tiny office, and we say, okay, it's going to be hard to set up this monitor and stuff in this small office. And the gentleman behind the desk says, don't worry about that. Don't set it up. And I said, okay, this is kind of weird because, as I said, it's a keyboard and mouse, but I'm happy not to set it up. Don't have to worry about the equipment failing because it's turned off.
Yeah. And
so he said, just tell me what it does. So I start explaining the software to him, trying to figure out how to explain it where he can understand it. I look at one point, and the fellow, his eyes were shut. And I said, okay.
This isn't going well.
This is not going well. I'm boring the hell out of him. I think he's sleeping. But then he would ask an intelligent question. Then every 5 minutes he'd pipe up with another intelligent question. So that person was a pure visionary, and he was visualizing the software. And that person was Jeff Bezos when he was just an employee in a 9 by 12 office at D.E. Shaw, where he did before he went to do Amazon. And, his enthusiasm, and it just remarkably to me, he doesn't have to see physically things because he can see in his head. And obviously he did okay with that skill in life. Another quicker story was we were having Hank Paulson meet with some of the select CEOs in the Valley for a breakfast meeting. And I was staying in the hotel where the conference was, and typically I was running late in my schedule, but this was the first thing in the schedule. I got there, it happened to be early by 5 or 10 minutes. And there was one person in the room, and that was Steve Jobs, waiting for this. So I had this, beautiful one-on-one conversation with Steve, and it was the most striking thing to me wasn't the conversation, but within the first 30 seconds, the man's aura was different, and you felt a different presence in the room than you have with most human beings you deal with. And you just knew that he was a different cat, wired a different way, and obviously was one of the geniuses of our time.
So that the reality distortion field was a real thing.
Yes, very much. He was in his own reality distortion field.
Yeah, it's pretty amazing to have a chance to actually witness that in person.
It was really amazing. Stayed with me.
So what do you think that the single most important factor has been for your success in your career?
Well, what I say is once you're in management in a serious way, and it took me a while to get that because I was an early stage manager, kind of believed I could do everything. But once you recognize that the task, the job is so broad and so deep, that you are a minimal direct contributor to it, you recognize that you really have to get the best team on the field. And so that's so fundamental. But a step beyond that, what I realized is that, it's important to develop your 1, 3, 5-year strategic plan, but by definition that's wrong, and sometimes fundamentally wrong, right? So the team on the field, if you just hire the people, the athletes, the men and women for that job at that moment, right, because of their particular skill sets, you're going to be wrong with that. So in a real sense, you have to hire the best athlete available because their job description will change, right? So when I looked at folks, obviously looking for overall talent and motivation being more important than talent, but there's two things, but the ability to read the changing tea leaves, to change with the times, to redefine their job, redefine their mission was to me fundamental.
So really kind of that growth mindset and the idea that you almost need like some flexibility in the mind and not just someone who knows how to like hammer the same nail over and over again.
Yeah, and that's the fundamental difference between middle management and senior management. So you see a lot of talented people who are great middle managers. They're content experts. They lead a small team very well where they're kind of the go-to person from that, and they know what they do. Senior management has to have an innate sense of looking at the broader context, understanding the team's important, and understanding that things just change all the time.
Yeah. Now, how about what do you think was the single most limiting element for your career?
Well, there's so many, I would say just what I addressed to. I took great pride in being operationally strong. We would weigh, measure, and count everything, and we wanted to make sure that we were running this organization as well as we can. And I said, in that context, you don't come out with the iPad, right? You don't make the leap. So kind of related to that is if you listen very strongly to your customers, they will give you the incremental improvements in your product. That I've seen time and time again, and you're crazy not to listen to them. But they never give you the big step forward. And I think Ford had the best line, if I listened to my customer, I would have developed a faster horse. Right? So the customers tell you how to make the horse faster, and you've got to listen to them. But if I had to do it again, I would, and I came to it later in my career, I would certainly think more outside the box, more away from what the customers are telling us, and how do we get away from the way we run the business day to day, which we do well, and get into the Steve Jobs, okay, how do I reinvent the future?
Yeah, make more cars and less faster horses.
Yes, something like that.
Probably easier said than done, though, I imagine.
Oh, definitely. And then you can go horrifically wrong with that because your ego can get in front of you. And I've run into many CEOs who wanted to be Steve Jobs, wanted to talk like Steve Jobs, and they should have just really been paying attention to the day job that's in front of them. And WeWorks would be in that category. Just sell real estate, right? The business concept seems fine enough. To me, there's a large demand for short-term leases of real estate, but go do that and don't get wrapped up in everything else. There.
Yeah, exactly. So bonus question that we ask everybody, and this is for a book recommendation, and it's typically, hopefully something that's maybe a little under the radar, or at least that you think is kind of underappreciated.
Well, I don't know if it's underappreciated. It's growing old now, but I will never forget the first time I read The Sun Also Rises by Mr. Hemingway. Quick, easy read, and I just love the simplicity of language, but getting across pretty, sophisticated thoughts there. And so if somebody's got an hour or two, just take that book and read it. It'd be a lot of fun.
That's good. I think that's actually, I've read before that Hemingway wrote at something like a 7th or 8th grade reading level, and that we probably could all stand to write more towards that end of the spectrum and have clearer thoughts in our communications with the written word.
I agree with that. So he wrote at that level, there's no doubt about it, but some of the insights were a lot greater than 7th or 8th grader. But you could read like anything else on a couple different levels. But yeah, that was quick reading. But he poured over every page to get it to be that simple doesn't come naturally. And I think it was Churchill who says, okay, if I have to do a 2-hour speech, I need 2 minutes to prepare. A 2-minute speech, I need 2 hours. So there's a magic to getting the work condensed for sure.
Yeah, I think, what was it? I think Twain said, I would have written you a shorter letter, but I ran out of time.
That's a great line. Yeah, I remember that one too. So it's very true. It's hard to be concise.
Well, Bob, thanks for coming on the show and sharing your insights. And I really enjoyed your book. I thought it was really nice to have not only the stories from your career, which, a lot of autobiographies have that, but also the lessons that you learned imparted in there. And it was a really nice combination of the two.
I appreciate that, then. I appreciate your time, and hopefully I was concise today. Hemingway, right?
Yeah, we ran out of time to be concise.
Okay, very good. Have a great day.
Thanks, Bob.
Thank you.
Before you go, do me the huge honor of picking up your copy of The Rebel Allocator, available on Amazon in both print and digital formats. It's a business person's guide to effective capital allocation, told in a coming-of-age story of a college grad who crosses paths with a wealthy Midwesterner. It's fiction for the nonfiction reader. Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.